Good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for Saturday night, May 6, 2023. I just want to point out that this is a free opportunity for you to post your swing trade frames from Friday night's reports and have me review them in public as part of our ongoing learning process. If you don't post them, I can't review them. And we're missing an opportunity. Just saying. The single biggest improvement that happened with Ken H's trading for swing trading was when he started posting these things for over a year every Saturday night with accountability and coaching notes from his closed trades and frame commentary on the new trades. That enabled him to become a fully actualized, self-directed professional trader with swing trades while he was running his own IT section inside a high-tech company. So if you want to get better, you got to practice in public with accountability and a coach. Saturday night is the time to do it, but I'm not going to post them. I'll comment on them, but I won't post them. Thanks to Chi Weng Chong for the 30-period regression line slopes, the z-scores of the different sectors. So we're going to notice that that everything has rolled over for a second week. We have finance in the S&P at the top. They're still above the zero line, so this is still positive, but you can see that the air is coming out of the balloon a little bit as it reaches natural resistance points of price. Energy is leading the way down and has more room to go before it becomes abnormal below 1. So this is just everything that comes down to -1 is simply an ordinary breathing of the market, and so movements between +1 and -1 are normal breathing cycles. It's instructive to note that tech peaked earliest and began to sell off first, and it's followed by materials, the broad market, and finance. Finance has actually held up pretty well compared, or considering the pain and suffering from the regional banks. But energy is on its normal downward cycle. So we should be looking for our favorite symbols like USO, CVX, XOM, and Devon Energy to be bottoming out and looking for them to be coming below the zero line on MACD. And when they work into the spring, we should be looking for possible entries here as it tentatively comes back to the zero line in MACD, and that gives us the same sensibility as the regression line z-scores do as well, the natural breathing of the market. Taking a quick look now at XLP, which is consumer staples, versus XLY, which is consumer discretionary. We think of that as the difference between aggressive and conservative postures to see which one of those is leading the way. And right now, the market is playing defense, because you can see that the conservative plays, even in tech, the conservative plays like Apple and Microsoft are leading the way in tech, because XLK is better than the Qs right now. So old school tech is defeating new school tech, and that's also reflected in the staples outperforming consumer discretionary. I want to jump to Dan's swing chart on silver. Yeah, silver is difficult to trade intraday because the silver contract, which pushes the silver price around in the industrial application, only trades from, like, if I remember right, from about 10 a.m. to 2 p.m. And so in this, and the bid ask spread is large. So if someone is bidding to buy here and someone is asking here, that spread, there's no trade until one of those guys, until the guys with stuff to sell decide to go sell it at the bid, or whether the bid decides to go up and pay the asking price. Until one of those two guys moves across no man's land, there's no trade. And then when you look over at SLV, the silver ETF, in that period of time, it is making tiny little moves in the equity market for the ETF, but it normally stays in a pretty tight channel until somebody in the futures market makes a move and pays a new price, and that causes the price to go from wherever it was to whatever that new price is. And so then you'll see it now being quoted up here, and that can cause a breakout to that new price level where it tends to stabilize, such as happened right here. And then apparently some guys sold it, and it came all the way back down. And so this is all characteristic of price that is trading in between the prices in the silver commodity itself in the futures market. And so here's one where obviously somebody bought it at the ask, and then there was no follow through, and it just kind of drifted down here back to what the previous price was. And in the same way, somebody decided to come down and sell some, and that triggered some buying activity back up to here. So the point being is that silver SLV is very difficult to trade in the ETF during the day because of this discontinuity that happens, that comes from the futures market. In my view, a better way to play that, if you want to be trading it intraday on the stock market, is to trade wheat and precious metals. Now, what these guys are is a precious metals and industrial metals broker. They do a little bit of mining, but what they really do is they are very savvy about buying the production of other people's mines and then playing directly in the commodities market as a broker of raw materials. And they do a very good job of that. And because they're a company that trades, their price tends to be very fluid during the day, and it also swings very nicely. So wheat and precious metals is a legitimate alternative to trading directly inside a specific precious metal. So you're getting a blend of both industrial and precious metals when you trade Wheaton. Having said that, this is a reasonable trade frame to look at 1 unit of risk, 2 units of reward, with a decision being having to be made here that if it does get up into here, you'd have to see somebody in the futures market really starting to hit the bid again to keep driving that north. But you could frame a 2-to-1 trade. It's just, if you look at the history of SLV, 4 or 5 years ago, whenever it was, when they increased the margin requirements for the accounts, it really stomped on the tradability of silver on the equity markets in the ETF. And it has really stayed range bound in prices. And I do think it's much better to trade that like on a 3-day, 9-day swing, a longer term swing, rather than even the daily swing. You can get these kinds of moves on the swings. It's much, much harder to play those during the day because of the points that I just made on that. Right. All right. So I don't disagree with this, but I would treat this as a special case. Now, I do want to come back and make this point again, and that the when you say MACD not favorable, and you're asking a question, when you ask the question mark, it suggests to me that you've stopped thinking about it and you want me to answer the question, which is a reasonable position to take. However, how many times have you ever seen the MACD in this position, where it goes below the zero line. It has come from a period of summer, fall, crossed the Red River, crossed the zero line, become winter, bottomed out below the Red River, and is positioned precisely, like if that was a clock, it's right exactly at 6 o'clock. It has come down and is ready to do something. Is it going to go up into the spring, or is it going to continue into the winter? Now, that happens every time the MACD oscillates. Like right here. It did exactly that right here. And now I'm going to ask you, are you really prepared to say, on the evidence of 2 data points, when the MACD goes below the zero line in the winter, bottoms out, and is prepared to go north, are you really suggesting that the evidence says that's not favorable for the long side? No. It actually says exactly what a farmer would say, and that is that under certain conditions, you can think about planting the first spring crop, but you better pay attention to the weather. The longer you wait, the more certain you are that the move is working. But then if you waited to here, now you only get this part of the move instead of that part of the move. So there is an absolute connection between how much uncertainty there is in the market and then what the payoff is if you're on the right side of it following price. So you should actually be able to draw a conclusion and answer this question provisionally just from this chart. That winter becoming spring, with the first sign of spring, there is always a risk-reward assessment of it, and not favorable, I then have to say to whom, for what period of time, for what trading strategy. If you were saying, hey, it's not favorable for the long side, that's another way of saying it is favorable to what? If it's not favorable to the long side, what would it be favorable towards? Short side. It's what it is actually even more favorable. It is in exactly a compound critical state because it has come down from the winter and is prepared to do either this or that. Now, you could decide which way you want to go ahead of time or try to predict, or you could just simply say, how can I, in a compound critical state, draw a tight risk box around that that's manageable? So now I have to ask, what is my MMRB over the time period I want to hold it? And then are there 2 units of reward in either direction? In which case I could frame a trade in either direction, and then I would say that the more tightly it is compressed, the more favorable it is for that kind of a breakout. And when you see a nice tight range compression like this, and the MACD exactly at the end of a long winter, which, if this was going to fail, wouldn't you have expected it to fail further? But it didn't. It spent the entire rest of the day recovering half of the distance and coming back inside of the river, the Z1s. And the VWAP is rising, and the dragon has started to roll up. That is actually the most favorable condition for the long side that you could come to. So what we've got to do is remember that every time we see this kind of formation, it means that there's maximum uncertainty, and the people who don't think it's favorable are people who are looking to try to predict a reliable move to the upside. What we got to say is, no, this is the most favorable MACD condition because we have had an extreme move into the winter, and it's out of the Red River, and yet price has recovered, and the dragon is turning. And there's a clear 2-to-1 to the upside. I don't know how you get more favorable than that for the long side. The longer you wait for it to confirm, the less and less reward that there is to the upside, because the real test is what's going to happen when it gets to 24. Is it going to break through 24? How many times has it been able to break through and hold above 24 in the last 3 years? But on the other hand, it's been the absolute best performer of the entire ETF stack. So here's silver on a 9-day. For one brief shining moment, this thing got to 28, which from 24 to 28 is 20%. On the best move it ever had is a 20% upside. This one had a 10% upside. So there is a reasonable 10 or 20% upside to this thing. And there is some evidence that it has cleared the previous statistical resistance at 23. So it is kind of in a no man's land. But you can see that we've already had the kata 2. It's had leg 1 and leg 2. Now what you're doing is betting, is there a leg 3 in here? No. Probably not. But if there is, it explodes like a maniac and catches everybody by surprise that said what I just said. On the other hand, if it fails, the last time it failed all the way down to 17. 24 to 17 is minus 7 on 24, which is 4, which is minus 30%. So it had one huge leg down, and then it gave 1, 2 to get back up to this key price level. This is such a key price level that the only sensible play, in my view, is a bracket trade that says, look, I'm not opposed to the idea that it could go, but I'm also not opposed to the idea that this thing could fail and come back to here to 20 and then to 17. So to me, that's about 5 seconds of evaluation to say, bracket trade, follow the money. Move on to the next chart. So the MACD histogram, that is not even a question mark on what that is saying. You got to be able to look at that and say, oh, MACD histogram just made an extreme move to the winter, which was driven by this, and this was enough to slow it down and to make the winter come into the station and just be locked in. And now it could go up or down, up 10 or 20%, down 10 or 20% easily, in a reliable way. But anybody thinks he knows where it's going, be nuts. There's no way to know that. On the 3-day, same thing. The kata 2, what you like is the preferred time to trade this thing, if we just go back in time, is after a long period of consolidation, now a breakout. What's that look like? It looks like a kata 2, doesn't it? And there's a measurable price level to get to. Look at that. It gets right exactly to where you're entitled to believe it could get to. And if you had traded it from here, there's your exit signal on leg 1. And then now, as it's coming down, you just I wonder how far it's going to fall. Is it going to fall to here? Well, it turns out that it didn't. Which means that now you have a kata 2 frame from right here with a risk box right there, 1850 to 2050. It's a $2 risk. Can you see $4 to the upside from 20? Yeah, to 24. That's exactly what it was. It gave you a 2R move to the top, and then it stalled right where you expect it to stall. So now we're in the position of saying it's at the very top of the channel in a consolidated compound critical state. And it's right where you would expect. It's doing exactly what you would expect it to do when the MACD histogram looks like that. On the 3-day, this thing is at the very peak of the summer at the top of the Red River. That's the extreme upside of normal moves. The last time it was in that kind of condition was like right here, and it sold off all the way through to here. And now it moved in an orderly fashion right to here. So I don't know. Could it do this? Well, it did that over here. It's easier when you get it when the Red River is down, when everybody hates it. Everybody loves it now. So to me, the upside is there really a 10 or a 20% boost in there? I think everybody that wanted to trade it on the long side bought in here. You heard me talk this week about selling off some silver for that very reason. It moved exactly to the limit of a normal channel after a really good move from 17 to 24. You know, that's almost a 30% move, 40% move. That's not what I want to start buying it. I'm ready for a bracket trade, but I'm under no illusion that this is just going to be some kind of, hey, people are waking up and discovering it. No, everybody's trading silver. Everybody that trades silver always trades silver. They're very well aware of the price is at a natural limit in that channel. The more likely move is down here to this level and then this level. And if that breaks to that level, and then the cycle will repeat. My point is that in all of this, that when you get to those sharp moves in the winter that have now stalled and become summer or spring, that is a favorable condition. You want to plant in the spring. So now if I'm down here on the 30-minute chart, all of the guys who decided to buy the anomaly are all satisfied, and then there was nobody else that came in. Why? Well, because in here, the silver futures market is already closed. So that's just retail silver traders exchanging money. So it's sitting right between the ask and the bid. So it could very easily drift to here. Now, if there's buyers that really want to buy this thing could blast through here because they'll start hitting the ask right there. And then that thing could go up to 25. But it trades in a much different fashion than the big fat indexes, which is what our edge in statistics is based on. Is everybody's always buying and selling DIA in a very, very narrow spread. Always. And that's why statistics work the best on that kind of instrument. So trade silver at your own risk. Give me the Dow, the Qs, the financial sector, that kind of stuff. Much, in my view, much better for statistical trading. Now, I mentioned wheat and precious. See, this thing moves kind of like silver. But even so, that thing moves a lot intraday, but it's a lot more liquid in between on the shorter time frames, like the 3 minutes, than silver ever is. Like wheat and precious metals on the 3 minutes, I can trade that. And the thing that you're looking for always, always, always is this: a harsh winter that is now becoming spring. Here's where it enters the Red River. There's your PSAR flip. There's your entry. It comes to here. It tests it for a few moments, and then they buy it this way. That is the best entry signal you ever got, except for that one. But look at where that is. So I don't accept the premise that that is not a favorable MACD. That is the most favorable MACD condition. But you got to look at it through that lens. That you've already seen the winter. You didn't get punished on any of that. You're just noticing that a lot of starving people that want to get fed and they need the spring, they got to plant. All right, there was some commentary over the last night about how to assess a histogram of trades, and we have fortunately a couple examples of that. I'm going to start with Jeff, who was did a nice piece of work here, if I can find it. All right, so this is for Hamad when you hear this. So what he's got is a weekly performance in the Kata 2 system that Griff and Phil teach. They teach the implementation of my Kata 2 challenge. Where's my annotation bar? Ah, there we are. So the very first thing that they do in this standard spreadsheet that we use is we just record the individual trade results of standard patterns, just the R multiples. That's the performance. This is the running total of R's. So the 0.5 win earns him 0.5 and his average is 0.5. The next one was 0.42, so he's up 0.92. Then he gets a 3.33 score, now he's up to 4.25, etc. So the average, the rolling average, produces this chart. And after you get out about past 20, you'll start seeing that the individual variation gets smaller, and now we're actually seeing what the expectancy of the system is. So even after 30 trades, his expectancy is north of 4. Yeah, there it is. The average is right at 0.4. Okay? So that's the first thing that we're checking. So the next thing that we look at is his maximum trade was 3.3. Very good. There it was. In the trade sequence plot. So that was the first trade, then the second trade, then the third trade, and that's the pattern of gains and losses through time this week. His worst trade was minus 0.9 R. That's very good. So no trade's worse than 1 R. So when I look at the histogram, there are 3 things that I look at. Here's the 0 line. Excuse me. The first thing I look at is I go over to the minus 1 line, and then I say, are there any trades that were worse than minus 1 R? If there's not, that's good, because that means that you could manage the risk that you observed. You estimated the risk that you could manage, and then you actually managed it. Now, the next thing I do is I come over to plus 2R, and I look at the shape of the histogram between minus 1 and +2. And what I'm looking for is a nice, orderly, normal-ish looking curve where the bulk of the trades are in this region between -1 and +2. This is where the normal system trades are without the fat tails. And because we don't have any trades worse than 1R, we've eliminated the fat tail. But what I'm looking for is the bulk of the trades to be between -1 and +2. Then I know that I have a system that is under control and which can be managed like an industrial process. And then the next thing that I look for is positive expectancy between the trades of -1 and 0.2. If I do that, if I have positive expectancy for all the trades between -1 and +2, then I know that I can make money with this system in a professional manner. And then the third thing that I look at is, are there any trades that were greater than +2? Because that means that I had a fat tail to the right, and that I'm open to letting my winners run. And I notice that his 2R line is here, so he's got 3 trades that had a fat right tail. That's good. So he has checkpoint 1, checkpoint 2, and checkpoint 3. All of those things are good. I have a system that can now be managed according to the principles of industrial manufacturing, which is what we specialize in. So now I'm going to look at the win rates. He's got 30 trades. He's got 17 wins. He had 0 scratches. And he had 13 losses. That gives him a win rate of 57%, a loss rate of 43%. And then I look for the average. The average win was 1.13. The average loss was -0.56. So imagine this, if with a little bit of luck, that 50 could be 60 and that could be 43, in which case it's a 3-2. So now the next thing I'm going to do is what I call the coin flip analysis. With just a little bit of luck and not having an order entry error which turned a winning trade into 3 losing trades, he could reasonably have gotten to 60% wins, 40% losses, which is a 3-2 coin flip. 3 times out of 5 he's going to win. And when he wins 1.13, and when he loses 0.56. This is a 2-to-1 payoff. So he's winning more than he loses, and when he wins, he's winning twice as much as he loses. Now, how many times a day do you want to trade a system like that? Every day, all day, as often as you can, at the lowest level of risk that allows you to achieve your financial objectives. That's what you want to do. That's 30 trades in 1 week, so he's getting 5 or 6 a day. His cumulative R is 12R for the week. His system quality number is 1.83. If you normalize that to 100, it's 3.35. That's good enough to trade already. And I want you to notice that he's only working on pattern recognition. He's not doing any sector analysis. He's not using formal trade setups. He's just doing chain trading, doing long and short, concentrating on the PSAR, and he's just experimenting with adding positions and getting some of his getting his mind right and the order entry and all that. But even so, at this early in the stage, without any optimization, he's getting a 3-2 win rate and a 2-1 payoff rate. That's what we're looking for. So that's how you assess that. So now I'm going to go to Griff's charts, and let's see what he's got, because he did some work in this area too, because they had a kata challenge this week for all the students in the kata 2 challenge course. And their cumulative R for the week, and Griff has a little more experience with that system, so I would expect this to be better. This week, in 23 trades, they scored plus 20 R. And this is the pattern. So he's got one trade that was worse than 1%, so I got to beat him up on that. But otherwise, he's got a nice system performance and one outlier, which was 9R. Okay, so if I just say that 9R was an anomaly and I only give him credit for 2, then that's still 13R on 23 trades, which would be an expectancy of about 0.56, which is 50% better than Jeff had, but I would expect that because these guys are teaching the course. But I'm also mindful of the fact that, yeah, if you do it right, you don't let trades go beyond -1, but you're open to the possibilities that sometimes you get those. And that will happen sometimes. As long as you are cutting off the left-hand side of the curve, you're in good shape. So now I look at his stats, and I'm going to go take a look at the histogram. The first thing that I do, remember, is there's going to be 3 things that I look at. So that's 0. And then I'm going to go look at -1. And I'm going to look at +2. Okay? And I'm going to check. The first thing is no losses greater than 1R. Maximum loss was 1.5. So there was one trade that was out of the frame by 0.5. So not perfect, but we can improve that. So I'm going to give him, a check minus on that. There's a mostly good, one thing to tighten up. Then I'm going to go look at the distance between -1 and +2, and I'm going to say, look, if I just made that 9R trade a 2R trade, this is massively positive expectancy. So that's good. It looks like a normal curve, and it's positive expectancy, so that's good. And then I see that there were some trades better than 2R, so we're open to the possibility of excess abnormal gains to the right side, and he got it with a 9R trade. So that's good. So the histogram thing is good. Now I'm going to go take a look at win rates. He had 23 total trades. He had 16 winners at 0.7. So 16 winners. That's a 70% win rate. He had 7 losers. That's a 30% loss rate. His average win was 1.59. Average loss minus 0.65. That's that's like a 2-to-1 win rate and a 2-to-1 payoff rate, and it's better than 2-to-1. Really, it's actually if we want to be technically correct here. And we will be. Let's be technically correct. That's a 2.3 to 1 win rate and a 2.5 to 1 payoff rate. You'll trade that forever. That means you're flipping the coin and winning 2.5 times. So if you flipped it 7 times, you'd win 5. And when you win, you get paid 2.5 And when you lose one. How many times a week do you want to trade that? All of them. And so they are on track with the manufacturing model of producing R. So that's pretty good. So for Hamad out there, that's how we analyze. Now, that's how we analyze the stats. The other things that we do to analyze in your learning journal, since I'm right here, I'll talk about it. Each day, you want to do a daily after action review. And what you're going to do is you're going to look at plan, prepare, execute, and assess. Those are the 4 phases. And for each one of those things, you're going to say, what were the things in planning that I did well? Like I might have done something and done it correctly, and I want to keep doing that. And then there were other things that I avoided doing, and it's good that I avoided them, and I want to make sure that I continue to avoid them. So these are the things that we want to sustain. And then there's going to be things that I want to improve. And that means there might have been some things I should have done that I didn't. And there might be some things that I did that I shouldn't. So I'm just going to itemize each one of those things. What am I noticing about my planning process? And then I'm going to list what are some things that I can do to act to fix that tomorrow just from planning. So I list a few things. Now, I've now going to move to prepare. Did I prepare? How did I execute? How did I conduct this assessment? Did I have all the materials that I need? Did I mark up the chart? Did I give gratitude and forgiveness? Did I follow my rules? So as we look at each of these phases systematically, we're looking at sustains, improves, and actions. So once I've filled out that chart, and I've listed all the things that I can act on, I'm going to pick 1 or 2 things to fix for tomorrow. Maybe I want to fix 1 thing in planning and 1 thing in execution. All of the other ones go on to the to-do list. All right? So everything that's an action that I've identified, I'm going to bring over here and put on my to-do list. And that's going to be a priority list. Like if I noticed that I was going to do that thing and I bring it over here and I said, oh, I already said I had to do this, and now I've got 5, 6, 7 or 8 times I've made a tick mark, I may be better out to do that thing. You know? Because it is a persistent problem. If it was a new thing that was just an anomaly and I don't have a lot of malfunctions in there, maybe it's lower on the priority list. But the things that are persistent problems should move to the top of your list, and let's fix those things. So I'm going to pick a couple things to fix, number 1 and number 2 for tomorrow, and then I'm going to tell my accountability partner that I'm going to fix those things. And I'm going to put it in writing. Where? In my trading plan for tomorrow, in my trader's journal, so that I put my affirmation, my intention, in writing to myself and say, I'm going to do that. And I do that before I go to sleep. Before I even go home and eat dinner, I'm going to make sure that I complete my professional process by doing this and bring that session to a close. And once I've committed to what I'm going to do tomorrow, then and only then I can go forward and start planning for the next day and then preparing. And then I have my little intention before I go to bed. I have done my planning, I've done my prep, I've referred to the things that I am going to intentionally improve on. I've checked in with my accountability partner. Now I can go to sleep with a clear conscience and a clear mind because I've done all the work that I need to do. Next morning, I just have to wake up and trade because I've done all the due diligence and I've gotten my mind right, and now I'm ready to trade. If you don't complete that work and then you go to sleep, that's going to be on your dream state mind. You're going to have nightmares. So don't do that. Get to closure before you go to bed. Dream freely and beautifully. Wake up in the morning with gratitude that you have another day in which to do anything you want to do because you are a free person. The learning journal then is what we do to perform the daily AAR. Now, here's the next phase of assessment. So now you're doing that every day. The next thing that you're going to do is at the end of week, you've got 5 of those. Put together a little weekly process. Take a look at your stats and your numbers and your SQN and plot that as a performance curve of the last 30 trades on a rolling SQN, and you can see how your performance is. And then you should also have a chart that shows your portfolio growth. And then you can start looking for themes on the weekly and then talk about that with a short weekly reflection. There's a lesson in the Foundations course on that. And then the same thing monthly. And then you should do a monthly review. Now, what Luke did was every 50 trades, he did a 50 trade summary review, and then he compared the batches of 50 to see if in the new batch of 50 he had learned anything and gotten better after each set of 50. He did that for 3,000 trades. He did that and reported on that in an annual trade debriefing, which you can find on tortoisecapital.net. And so did Glenn Osborne, a certified coach. Ken H. did that. So go listen to their annual debriefings, and you will see the results of thousands of trades assessed in exactly that manner, and then commitments to trading strategies and improvements and learning strategies that are based on evidence, that are accumulated as a result of doing the daily work of AARs, end-of-week reflections, and then building forward with your accountability partner and your coach to improve performance in a systematic, disciplined manner. That's what a professional would do. If you don't do that, then you're not professional. And if you're not professional, you are a hobbyist. And if you're a hobbyist, you have a natural disadvantage when you go into the marketplace with serious people that are professional. So don't be unprofessional and get in a ring with the champ. Not with your family estate money. Okay? So that's what I want to say. Go look at tortoisecapital.net for those annual debriefings. In the Foundations course, there is a process for a weekly reflection. Find it and look at it, and we'll talk about it tomorrow during the Foundations check-in. All right, that's everything we got for today. We'll get this published and posted, and see you tomorrow.